Ben, Patrick, thank you for joining me here today. Ben, I'm going to go ahead and start with you. We may have a lot of viewers tuning in right now that are feeling a bit anxious, a bit nervous, a bit unsure about how to put all of this together. What is your advice for an investor watching here this morning?
So it's obviously an anxious anxiety here in the markets. But I do want to say, though, that the collapse that we're seeing in bond yields as well as in oil prices is really reflective of these two dynamics of the virus outbreak in Italy and leading to a larger quarantine and what happened with OPEC Plus, that these issues can be resolved, right? There's obviously there's maybe a relief in the future. At the same time, you don't want to act here in this market at this moment, clearly, because as you mentioned, like, we don't know how far and how steep the drop will be when the market opens. So I just simply say, like, watch what the bond market is doing. When you see somewhat settling out in the low in yields, there may be somewhat recovery in the future.
Patrick, we are certainly watching the bond market here carefully. We are also watching what's going on in the equity markets. We know that the Fed is watching, too. They gave us a surprise rate cut. They're going to be meeting again. What do you think they should do, if anything, because the last action perhaps wasn't the right one, at least by some investors' viewpoints, because the selling seemed to accelerate after that. Perhaps it induced more fear than was intended.
Well, the Fed doesn't really have a silver bullet here. The Fed can help with a number of things. If the collapse in the price of oil leads to credit stress, it can help with that. It can certainly, there's room for fiscal policy as well as monetary policy and helping sustain demand through this period. But there are no silver bullets when we talk about the prospect of supply chain disruption. I mean, the Fed can't wave a magic wand and make that go away. When it comes to how an investor should look at this, I would say you had an investment plan. Hopefully you had an investment plan that was not predicated upon this bull market going on forever or growth going on forever without interruption. This is the time to stick with that plan. The reason why I say that is because right now, safe harbors are extremely expensive. They've been expensive throughout this entire recovery, but now they're even more so. And piling into them at this moment is something where you're giving up a lot of underlying cash flow unless you think that, I mean, what the bond markets are saying right now is that the Fed is going to cut and it's going to interest rates are never going to rise again, or at least not for the next 30 years. Unless we've turned into Japan with a shrinking population, I don't think that's what's going to happen. And so you pay a very heavy price if you simply rush into those very expensive safe harbors right now.
Okay, so you're saying stick with your plan previously. We're going to bring in Richard Steinberg. He's the chief market strategist with the Colony Group. And I want to bring your attention to a tweet from our very own Jim Cramer. He writes, the collapse in yields and oil is signaling an imminent recession. I think we need to parse everything and remember that while most stocks aren't buyable, they will get to be that soon enough at this pace, So, Richard, as I bring you in here and you can talk us through both strategy and psychology, when you see a tweet like this from someone like Jim Cramer talking about an imminent recession with all of the factors at play, what's your advice to investors that might be getting very anxious about seeing things like the 10-year at 0.5% and oil prices falling 20%? Patrick? Or I'm sorry, let's go to Richard.
Yeah, so Courtney, I think first people have to breathe. I think that's really important at this stage. The second thing is, the way I read Jim's comments is, our investment team has dream stocks that they want to buy at lower prices, and you can let them come to you. Clients should stick to their plan, and if they have cash, they can slowly deploy that, as Jim says, because you're going to have an opportunity. One of the things we have to watch really closely is the mismatch in liquidity. So you have some small cap and mid cap names and other names that aren't as liquid, but you have very liquid ETFs behind them. So it may create some opportunity. Investors should not panic and should be very careful of liquidating into this downdraft and just kind of wait to see how things settle in.
Okay, Ben, so you heard that tweet from Jim Cramer talking about a setup possibly for a recession. What do you make of the price of oil and really the implications for the broader global economy here?
So the fall in oil is so dramatic that this will put a lot of pressure on global inflation, because energy being a large component of that. And this is also what bond yields are saying, that the inflation environment will be so benign, if not in some countries maybe close to deflation, that's why they will stay low. But that also, interestingly, to the other guest's point, creates a benign backdrop for recovery in the future. In other words, if yields stay relatively low because of low inflation, the recovery for equities will be good in the future. So I do think that you want to look at it that way. At the same time, the collapse in oil prices is to be watched, not only the inflation implication, but also for credit markets. I think that's what we're going to be paying attention a lot to today, the credit markets, how they react.
Patrick, we are just about out of time, but I want to go ahead and give you the final word here. When you're looking at the treasury market, that seems to stoke an awful lot of fear in investors. What's your advice there?
The Treasury market is signaling that there is recession risk, but then again, it's been signaling that for the past year, over a year, once it partially inverted back in over a year ago. So, the prospect of a recession is real. The prospect of an economic shock is real. But that's not going to be the end of the world, and investors need to be looking through the immediate crisis.